In this video, we're going to talk about another tool. We've already discussed the cash flow statement in a previous video, and this statement we're going to talk about, or in this video, we're going to talk about the personal balance sheet, right? Again, this is slightly different than for a company, or at least the development and understanding and the analysis is different. So it's a summary of assets, what you own, your liabilities, what you owe, and then in the end, there's a plug figure. And this plug figure is referred to as your net worth. And this is actually the most important number in financial planning. Our ultimate goal is to find ways to increase net worth. When you retire, you want to have as much net worth as you possibly can. So again, this balance sheet reflects your financial position at a specific point in time. It allows us to determine net worth. And of course, we need to update it periodically as changes happen to assets, changes happen to debt, etc. But let's come back to this net worth idea. Another definition of net worth is if you were to sell everything that you own, convert all of your assets to cash, and pay off all of your creditors, so you now owe nobody any money, the amount that's left is what is your net worth. And that's how much money you will have to spend for the rest of your life. If you were to quit working today, sell all of your assets, pay off all your debt, that's how much money you would have to live on for the rest of your life. So it's a very critical number in our analysis and our forecasting for retirement planning, estate planning, etc. So what are the assets? There's three primary categories, if you will. Liquid assets, those that can be sold very easily without a loss in value. Have a whole list of household assets like cars and the house itself, furniture, clothing, right? And we may have to be able to establish market values for these assets. The home's probably the easiest, but if you think about a car, you could probably get that value from maybe Kelley Blue Book could give you a forecast of its value. But your other assets, it might require a little extra work. You might, if you're really interested in getting a pretty exact number, you may have to get some things appraised. Investments, four primary investments we can talk about are bonds. This is where we're lending money to companies. Stocks, where we own buying pieces of companies. Mutual funds is a company that invests in other companies. So we're buying the stock of a company that owns the shares of other companies. Again, we're going to talk about all of these in later chapters. And of course, you can buy real estate, right? You could buy actual land, or you could buy rental properties, right? So again, all of these things are assets that you can own. On the liability side, we're really going to break these into two areas. There's current liabilities and long-term liabilities. Current liabilities are all those things that you're going to expect to pay for within a year. Long-term liabilities then is everything else. It takes longer than a year to pay them off. And again, as we mentioned, net worth is the difference between what you own and what you owe. So here's a quick little example, right? We have liquid assets, $4,000. So the total assets, $9,000. We have current liabilities. In this case, they're just talking about credit card balances. We'll pay off $2,000 this year. Long-term liabilities, the total liabilities, we have no long-term liabilities. They're all zero, so our total liability is $2,000. Now, it's possible that you could have credit card balances. We expect to pay off $2,000 this year, but you could have the remaining credit card balance could be long-term, right? So you know what you're going to spend this year, but what if you, in this case, what if they owed $12,000? They'll pay off $2,000 this year, but there'll still be $10,000 going out. So it could be, credit card balances could be in both spots. In the end, the net worth is $7,000. If you took all the assets, subtract out the liabilities, you're left with net worth. So what happens when we go through life and we make transactions? Some changes are going to affect your balance sheet and your net worth, and other things will leave your net worth unchanged, right? So think about, again, this previous example we have here. What if this person wanted to buy a car? We're going to use some cash. We're going to use some loans, right? And we're going to also buy this car. How would that affect the person's net worth? Well, in this case, you can see the cash. We spent $3,000 in cash. So our total liquid assets went down to $1,000, but now we have $20,000 in the car. Used to be $1,000, now it's $20,000. And if you go down below here, you'll find out that the debt piece, now we have $16,000 is what we owe in debt. So again, now we have $25,000 in total assets, $18,000 in liabilities, but our net worth didn't change. So some things will just rearrange things in one area or another and won't affect the net worth of the company, of the person. So again, there is a worksheet. It's called the Personal Net Worth Worksheet. And again, you plug in liquid assets. We have investment assets, long-term investments. And again, you can see it does percentages. So of total assets, 94% of my total assets come from, quite frankly, most of it all comes from my residence. If you also notice up here, I have very little money in my IRA accounts, right? No money in my corporate retirement accounts. So again, it gives me pictures of what my assets look like. The other side of the coin then is the liabilities that I owe. How much debt do I owe? In this case, 65% of my assets, all right, are backed by long-term student loans, right? If you note here, $3,800 though is a student loan, right? We'll talk about this a little bit later when we get to the loan section, but obviously student loans don't have an asset to back them up. So when you borrow money for a student loan, it does nothing but reduce net worth because you're not buying a thing. You're buying an opportunity to make more money later. In the end, 41% is the 41,000 is their net worth. So 28% of their balance sheet is net worth. That means 71% then is debt. Again, if you paid off all of your debt, converted everything into cash, this is how much money you would have to spend for the rest of your life. Hopefully you recognize that that's probably not enough. So what happens? How does the economy affect our balance sheet, right? Obviously, good economic conditions are going to be favorable, right? Better job opportunities and income. Maybe we'll lose jobs in a bad downturn, right? But net worth can decline to the point of actually becoming negative, right? So what's the impact on a person's net worth of borrowing money to go to school? We talked about that on the previous slide. Initially, it is a negative impact on net worth. But when you get that job and you start paying off the loan, right? The loan is reduced. That means that whole value just goes from the liability section. It all goes into the net worth section. So now you have more ownership, if you will, or there's more that you have to show, which means you'll have more that you could spend at retirement when that day comes. So wealth is built by using cash flows to invest in assets without increasing liabilities, right? We also want to make sure that we purchase assets that will appreciate in value rather than depreciate in value, right? So buying a home, even though it is not really an investment, a home should appreciate in value over time. When you buy a car does nothing but depreciate over value. So net cash flows can be used to decrease liabilities, which again increases net worth. So net worth can change even if net cash flows are zero, right? I mean, the value of an asset or investment can go up or it could decrease, right? Loans can be paid off, right? So even if we have zero net cash flow, we can actually still see changes happen to the net worth. Now, in conclusion, we want to talk about a few ratios. There's something referred to as a liquidity ratio. You take the liquid assets and divide it by current liabilities. Just talks about our ability to make payment, our ability to save, right? So again, for a personal balance sheet, this came from the slide number 20, 4,000 with the liquid assets, 2,000 with the current liabilities. So we have a liquidity ratio of 2.0. The higher the ratio, the greater the liquidity. Maybe a bank would say, unless you have a liquidity ratio of 3.0, we won't lend you any money. So they'll do this calculation to determine whether or not you're entitled to get a loan. A debt-to-asset ratio, total liabilities divided by total assets. Again, from that same slide, about 22% of the assets, right, are still owed to the bank, if you will. So in other words, 78% of the assets I own, free and clear, but 22% of it is still actually owned, in quotes, by the bank. A higher ratio means there's higher debt, higher leverage. I'm a more risky person if I have lots of debt. Again, the bank may look at this number. A savings rate gives us an idea of how much money we're actually putting away. Now, we could break this down into some smaller parts. I'll talk about that in a second. But this is just your savings during the period divided by disposable income. Again, in this case, $400 divided. We're saving roughly 16% of our income is being saved. That's actually a pretty high number. Maybe we should break this down, though, into savings for an emergency fund, savings for retirement, right? I think we should probably want to have 10 to 15% of our savings going towards retirement. Now, that includes corporate retirement, personal investment in retirement, etc. But, that 10 to 15% range is a good number to shoot for as you're thinking about saving for retirement. Now, there are some other ratios we can look at as well. There's the mortgage debt ratio. You take the mortgage payment divided by the cash flow for the month. What percentage of your cash goes to the mortgage? What percentage of your debt goes to the mortgage? Goes to the cash flow, And there's a number of other ratios we ultimately can calculate. But all of these ratios, we would like to look at them not just today, but we would like to look at them over time. We would like to make sure that they're moving to a more favorable position. So the key to budgeting decisions about future plans, right? How can I improve net cash flows in the near term? And how can I improve my net cash flows in the distant future? All of these will have an impact on net worth. Again, I want to emphasize that again. Probably the most important number to understand when we're talking about financial planning is a person's net worth. That's where we should focus our efforts, trying to find ways to increase net worth. I'll see you at the next video.